Hey guys, welcome back to the Capital Mindset Show. We are your hosts, Austin and Fabio, and today we're going to be talking about the Canadian oil companies. This is a subscriber request, kind of following up from a previous video that we did a couple of weeks. What was it, a couple of weeks ago now, or was it a couple of days? I don't really know anymore, because usually, like, when we film, we film like 9 videos all at once.
Well, that's extreme. We don't film 9 videos, but we film sometimes a couple at once. But I think it's a week now since that video was out. But anyway, regardless, we are going to add in some other oil companies too, and kind of add a little bit more flavor in one pipeline company. So we'll talk a little bit about each one. So we're going to be covering quite a bit. We're going to try not to make it an hour. So we can cover everyone and like a brief overview of what the company does, the thesis behind it, etc. So it's not so much that it's our thesis, but like the thesis of what you can think or look for if you're bullish on it, etc. Some of these I've owned, and I've addressed that in that video. And the one that's missing from here is actually Gazprom. But we're not going to discuss Gazprom in this video. So I think without further ado, we can discuss the first one. We're going to go in order. The first one we're going to talk about is Occidental Petroleum. And this one will be shown in the model today. And the last one I did not show it in the model. But Occidental Petroleum, we just take a look at the quick price movement. It's actually been absolutely destroyed if we look at a longer term chart. So in the 5-year. And Austin, guess when it started to just rocket up?
A 2020 election right after that.
Oh yeah. I mean, I've addressed the thesis that what we did, where I work, how we actually made a big play, made a decent amount of change. And the thesis was fairly simple. I addressed it in the other video, so I won't really get into it now unless, Austin, you have any questions. I mean, extensively, because we were talking about it for a long time now. But basically, if you remember, oil is an inelastic good, and you need to evaluate the demand and relative to supply, right? And so if you understand or come to the understanding that oil is oil, right? That's what I always say with commodities, that the only way you can therefore effectively raise prices is to hamper supply. So you need supply to come down. OPEC realizes that's why it's a cartel. So it's a cartel to control supply, because supply at the end of the day is actually what dictates more or less the prices in fluctuation with demand. So demand rises about 1% per year. The United States has attempted to curve the price along with other countries. However, this is only going to be temporary, because I think it's like 50 billion barrels or 50 million barrels in the reserves that have reduced, not billion, million barrels. And the total consumption of the United States, you know what it is, Austin?
Daily? I would guess it's a lot. It's probably a lot.
It's about 18 to 20 million. So if the reserves that they're releasing are 50 million and the daily consumption is 18 to 20 million, it's only going to really realistically last for just a couple of days. But the thing is, it's being done across the globe by a bunch of countries. So the hope is that it will do something. But typically, and other creators have kind of talked about that, typically you would want to see that being used in national security instances, not to just alleviate economic turmoil, because at the end of the day, United States can fix this problem tomorrow. And in fact, if I remember, there's actually news coming out that the Senate, or was it the Senate or the House? I think it's the House, is actually pushing for newer legislation to actually on stricter monitoring of drilling within the United States. So this is actually more bullish, because it's the opposite of what you would want if you were a bear on the big oil companies. If you're a big oil company bull, you want to see the House put greater restrictions on the United States. The more shackled the United States is in its oil production, the better it will be for these investments. Okay, that's the key, and that's actually the biggest risk. The biggest risk for these oil companies is the big oil companies is if the United States comes back online. So that's what you have to be very careful about. Because the United States coming back online, it's like the big giant that no one's talking about. Okay.
Yeah, it's like it's like waking the sleeping giant.
Exactly.
Yeah.
So if they come back online, you would see the price of oil potentially collapse because supply would be kind of unhindered. But I doubt that's going to happen for now. But that's something you have to keep an eye on. So Occidental Petroleum,
I actually kind
yeah.
of have a question about this, because the results of the election it resulted in the victory of Joe Biden. Does this kind of play a role into your thesis here? That I know that we've talked about this in previous videos, maybe for some of our newer viewers who might not know as well.
What, the victory of Joe Biden plays into the thesis?
Yes.
Oh, no, like that was the play. So we were setting up positions that we would buy if either candidate won. It just so happened that if Biden had won, our thesis was to actually invest in large multinational oil companies.
Yeah. So big oil. And then if he had won,
Correct.
your investment would have proved fruitful. So, okay.
Correct.
Cool. Continuing on.
And well, actually, it wasn't even that. Gazprom was a big investment. Well, I can only speak for my portfolio because I have to refrain from really talking about the company portfolio, but I can talk about my portfolio, but you can make your own conclusions about what that means if it's reflected in that portfolio too. But I invested quite a bit into Gazprom, and that was actually more along the lines of the natural gas prices as well as oil prices. And what I didn't expect was the approval of Nord Stream 2, or the push for Nord Stream 2, which by the previous administration, they were actually hampering that, which was actually like the icing on top. So my investment in Gazprom, both the calls that I had, which I no longer have, I've had to sell them, and the common stock have done significantly well. So let's go back to Occidental Petroleum. With Occidental Petroleum, I actually owned this company and I sold it prematurely. And I was adding to my ConocoPhillips position, which ConocoPhillips isn't going to be discussed in this because I addressed it in that video. The only one that's repeating here is Transocean. But Occidental Petroleum did really well. It's up about 300% from the moment Joe Biden won the presidency. And from there, I think I sold it when it was at 100% gain. But you see, I left a lot of money on the table, and then I put it into ConocoPhillips, which did well, but not nearly as well. So you can see how I actually played with the soap, so to speak, and I ended up with less soap. Right? Yeah. If I would have not done anything and just let them ride, I actually would have more money today than now I do. All right, but I'm not going to complain because it still was really good. And so let's actually do our standard discount rate of 10%. And I think, yeah, it's a buy across the board based on the cash flows, because Occidental Petroleum, the reason why it actually had the greatest run up was because it was so cheap, because of how devastated they were from the drop in oil prices. They were so devastated from it. And they just had a lot of debt coming onto the balance sheet from their acquisition that they just went through. They actually were bidding up Chevron. And Chevron is definitely not the company you want to be bidding against, because Chevron has a ton of capital. So Occidental Petroleum gave the acquiring company an offer they couldn't refuse. And it was good for those guys, but not so good for Oxy. And Oxy was punished because of that. But good enough for them that 2021 would be one of the highest rises in oil prices. Because again, the United States was coming back online, or something not coming back online to the same extent. Rob, the popular investor, talked about this. It's the importance of sentiment that drives capital investment. And if sentiment isn't there, then you're not going to get that boost in investment and therefore supply. So let's assume no buybacks, and we're being a little bit conservative there. In fact, I probably should have issued some dilution, but I think going forward, they're going to calm that down. They did that out of necessity for the moment in time when oil was still cheap, because the damage to production still hadn't been done. And now the damage is kind of almost permanent in some instance, because again, sentiment around oil is not getting better for the producers. Okay, it's not getting better in terms of investing in the United States production. So ConocoPhillips has projects elsewhere. I think one of their largest projects now is going to be in Denmark. Well, they just discovered a large natural gas reserve. So I'll say no percent for now. And then I think, for example, let's see so they're actually almost at all-time highs again. The sales are recovering. Yeah, the sales are recovered pretty much. So we don't have to assume any cyclicality. Let's assume growth rates from here. But the problem is it's already a buy.
Yeah. So it's like you don't
So
even have to assume
it's
anything. Just
already a
look at how,
buy
yeah.
because of
Yeah.
how cheap it is. But that's because I'm discounting it at 10%.
All right.
If I
Plug the
increase the
15,
discount,
our
no, we're
lovely
going
15.
straight to 20. This is to
Oh,
show you
wow.
how cheap this is.
Yeah.
Okay. So then I have to assume so like if you believe inflation is going to be a problem, this is not going to be a topic about inflation. But if you believe that,
Yeah.
remember, energy is a good hedge against inflation because it's something that's a necessity, inelastic demand. We will have to pay for their products before we pay for other products. You will have to cancel your Netflix subscription before you stop paying for the gas to light up your home.
Yeah. Or the gas to go to work.
Or the gas to go to work. Yeah, precisely. And companies will have to make cuts in other areas before they make cuts to energy. Energy is so vital and people really discount that. So you have to operate, and this is actually kind of like a little bit of a comment. You have to separate your beliefs about how the world should be and observe how the world is. And then from there, draw conclusions and be honest with yourself about those conclusions. Is your investment going to be fruitful? So, for example, investing in oil at the time when one did is actually a separation from the notion that, I'll just say it. I think for the most part, colleagues of mine were saying that if Biden won, it would have been bad for oil, but it was actually precisely the opposite. It depends on which oil company you're talking about.
So like the smaller oil players, the smaller oil players clearly got decimated in this, but then the larger oil players were the ones that ended up doing really, really well from this.
Yeah. Ones who have the ability to basically navigate the political environment, we're doing well. Because if you looked at the donations, this was information that we kind of paid for this research. And we found that the donations being given to both parties, from our research, we found that it was, I'll just say, because they were donating more in aggregate to Joe Biden, the larger oil players, and then the smaller players in aggregate made up a greater sum of donations to Donald Trump, but they were made up of smaller oil companies.
So now I kind of have a question too, because there is this talk of sort of an environmental push in our country, especially at the moment in time, yet big oil companies were the one funding Joe Biden. So not contributing to Joe Biden's campaign. I want to make sure I watch my words. They were contributing to Joe Biden's campaign. Is there potentially a correlation here? Because to me, that kind of seems like a contradiction of sorts, just as a very basic and broad overview understanding of it.
What's the contradiction? I'm not following.
Well, the contradiction is that big oil was contributing to the Joe Biden campaign, which is for environmental reform, basically. So doesn't environmental reform include going more green, so not using as much fossil fuels, et cetera, and so forth? Because to me, it looks like a contradiction.
I mean, I don't know how deep you want me to get into that, because that will maybe make some people very upset. But
but again, like, this is the Overton window warning. We're just saying it how it is.
I mean, as an investor,
this is like legitimate fact.
As an investor, I think, like, I don't have an Overton window. There's not really something that someone could say that upsets me, but I know that's not a reality for the world. But
I'm like,
well, I'll just say this in like a broader sense, on a macro sense, you have to acknowledge the limitations of current technology, be honest with those limitations. Because if you try to idealize the world and it's not so, then you're just going to get punished for that, because the world will operate within its rules and boundaries. And if you need, for example, X amount of energy, and the results show at the present moment, regardless of what we want or believe or think should be, that X amount of energy is needed and its current methods or alternative methods aren't sufficient to provide that energy, then we have to be honest and say, okay, can we go about said policies without causing other problems elsewhere? And if you, for example, can identify that and see policy being enacted that will have, some negative effect, you can profit tremendously from it. It's incredible. So there's always been opportunities in history to profit off of bad policy. and good policy, but bad policy is actually sometimes the best one, because usually people are more biased on the favor for bad policy, which is interesting. I mean, you could say like the same philosophy occurs with like the gold bugs, for example. The gold bug thesis is people think there's going to be a tremendous amount of inflation due to the policy of the central banks. So you can see in it of it that it may be right, may be wrong, but the thesis entirely relies on bad policy and the identification of bad policy. Now, the key is, can you identify bad policy? Well, in this case, if you can come to terms with the fact that for the time being, fossil fuels are a great portion of the energy requirements. And then you take that little lesson we learned in macroeconomics or microeconomics, that demand curve for energy is inelastic. Therefore, then you can conclude that the best way to profit is to hamper supply. This is what OPEC figured out, right? It's a very basic concept. OPEC figured this out a long time ago. It's why it's formed, why it exists. And if you are the large oil companies, you are going to desire policies that will hamper supply, right? Not your supply, because you still want to make some cash. You want to hamper the aggregate supply so that you can sell for a higher profit margin. And
Interesting.
then,
Wow.
I mean,
Okay.
no, it's not even a surprise. I mean, that's not debatable. That part,
Yeah.
because the only way you can increase price in an inelastic demand curve, right? Or not the only way. The only way you can increase price in a commodity is to affect supply, right? Aggregate supply. And then just so happens that oil energy has an inelastic demand curve. So if price goes up, the delta change in quantity demanded won't change as much as the price. So profit margins will skyrocket, which is, so if that's your understanding and that's the goal, what if you were an oil executive, you're the CEO of ExxonMobil, what is going to be your political strategy? Because we all have to operate within the world we live in. So all these companies do have political strategies, right? So what would be your political strategy? Well, the political strategy, therefore, if you follow the same logic tree, must end up in a place where you again conclude that the energy still requires the world's use of energy still requires a certain amount of fossil fuels. The current replacements aren't there yet. Okay. And then how do I get higher profit margins? Well, how do you enact that third one? You have to then support policies or politicians who then support policies that will hamper down supply. And the United States was a big rogue nation being maybe being used incorrectly. I know the proper definition of rogue nation is a little different, but rogue nation for OPEC. From OPEC's perspective, the United States is a rogue nation. And they were producing all this oil that brought down the price of oil globally, which was really good for the consumer, not so good for the large oil companies. And you can back this up, right? So for example, we take a look at the big boy XOM. Let's take a look at when they started suffering. You can see here it immediately coincides with US shale oil production. Terrible performance and stock price. Everyone considered oil dead, right? And then again, when do you think they started popping?
After the 2020 election in this instance.
Yeah. Because immediately you saw you had to price in the new agenda, right? And the new agenda was highly favorable for large oil companies. And if you knew that, you would have profited tremendously off of it. But the general consensus, for some reason, because people don't really like think through it fully, they thought, this candidate is terrible for oil, and then this candidate would have been good for oil. It's like, well, that depends. You're kind of coming to that conclusion probably on tribalistic lines. So then if you dug deeper, then you can kind of then conclude differently, right? And it's kind of like how China right now is enacting policies that are destroying their energy grid system, because they're basically boycotting Australia. So they're allowing international politics to get in the way, and that's harming domestic production. So that energy crisis going on there, we can profit from it. Again, identify the energy crisis or identify policy, bad policy, and then you can profit from it. That's the goal. As investors, we're not trying to be political. We're trying to profit. Okay. We're trying to make money. Leave the politics at the door. But Rob talked about this. The difference is, I've explained this before, is he can probably talk about it a little more than I can, because someone will look, and another American will hear me say that and say, and even though I'm Venezuelan, but I guess you can say I'm American too. They'll say, okay, you're being very political, blah, 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 blah. And if Rob says it, well, Rob's all Irish, so he doesn't have, skin in the game, unless you're talking about Australian politics. But anyway, the point is Occidental, very cheap. So that's what we just talked about, is kind of like broad base. You're going to see this with all of them, except for EDP. We'll talk about EDP in a sec. So let's actually go over to SU. This is Suncor. This is the Canadian company. And let's discount it, standard 10%. Hopefully it loads quickly. Scrape.
Yeah, it always takes a quick second. So
no, with Oxy, it was very quick. Sometimes it's slow. I guess it's because it's Canadian. Yeah. It's a Canadian company. So let's actually, so we see some buybacks. I actually think they'll continue to do some buybacks, but let's do 1%.
Just to keep it safe in this instance.
Yeah. And then, she's just taking a long time. So again, with a 10% required rate of return, it's going to be pretty conservative, and it's probably going to come out as a buy pretty quickly. There we go. Finally. All right. So price target, we see buy. Remember, Oxy was a hold. So we'll go back to Oxy hold, but the analysts have a price target of 40, which is hilarious. So it's even up higher. And then here we have a buy rating with a price target of 29.26. So you can already see they're all cheap. So the difference is, do you believe, this is very key to the thesis, do you believe oil will continue to roar higher? And really think about what that means. I mean, that's pretty scary if it is. Globally, if oil rises higher, that's going to start to lead to different levels of crises, right?
Yeah.
Not only will it continue to cause inflation or consumer price inflation beyond what consumers really can handle, but I mean, the first countries to really suffer are going to be the poor countries. And then I think Sven Carlin talked about this, and he's actually absolutely correct. Right now, the United States has been used to, or the West has been used to, kind of a lack of competition in regards to aggregate demand. As the East comes online and becomes wealthier, their demands are going to be more met than before. So if their demands are rising, and there's more of them over there, there's billions of them, okay? And there's only 320 million Americans, something like that. And then about 400, 500 million in North America. So if the East is getting wealthier and wealthier, and there's billions of them, what happens when aggregate demand over there is up to a point and the wealth is there to back it up? What happens when the suppliers want to supply more over there than over here? Right. This is like the future that you got to actually start to think about. Commodities are going to increase in demand as the world's populations begin to rise, right? In terms of wealth. And the wealth is actually, depending on how you define wealth, I think I can define wealth as what you can get, the resources you can acquire. It's not about the money. Money is actually just a figurative symbol of the wealth. It's a tool that we use to transact. But the wealth is what, that value, that representative value can acquire. And what can it acquire? What do we want at the end of the day is resources. So if the East becomes wealthier, gets more supply to them in terms of resources, what would that mean for us? Well, it means we probably have to pay more over time for those resources. And it could be, you could say that in a way is our wealth declining, unless aggregate supply at the same time production is going to rise in tandem with that, which is something you got to think about. I'm just basically just touching the topic, but hope everyone's kind of like thinking that in the back of their mind.
Yeah.
Okay. So at a discount rate of 10%, this thing's a buy. Let's discount it at 20. Let's go crazier with it. And you can see if we discount it at current cash flows and we assume no growth, it's not a buy, which is like, wow, okay. That shows how cheap it is relative to current performance. So I can already say I can't assume decay, right? Because it's already discounted at zero growth. If I go lower, it's going to, obviously get lower. But if I even assume like a 10% rate of return, or sorry, not rate of return, growth rate, it's a buy. And then let's assume 5. Okay, so at 5, it's not. So I'll say 5 is our low. Then we'll go 8. 7, 6.
So it's like right at 6,
Yeah.
6.5, something like
Yeah,
that, or even
exactly.
7. Yeah.
So yeah, and again, this ignore this. This is just like a totem pole. This is if you really believe these are the proper scenarios. I actually think there is a case where, remember, what happens in the United States comes back online in one of these scenarios, that is a risk. Okay. So I'd actually imply that. And if that happens, oil prices will come down. So Rob again, to quote Rob again, he put it really beautifully. At any point, the United States could come back online tomorrow. If the executive branch or the government of the United States, the entire government of the United States comes together and says, we're going to increase oil production. Oh yeah, they can do it. Oh my gosh, they can do it. And then that would be tremendously risky for any of these oil companies that you want to buy. Tremendously risky. Okay. The biggest risk is the United States. And that's a wild card. As long as the United States wants to, for lack of a better term, cuck itself because it's doing it to itself. It's not no one's cucking it. It's doing it to itself. Then these companies can become very interesting. And if you think aggregate demand will increase by 1% per year and supply will continue to be reduced in certain areas, and OPEC continues to play along, this can be really good. All right. Anyway, moving on from here, CNQ, and then we'll kind of have our final thoughts on all of them together in aggregation. So yes, it's fair to say we can assume, let's put 8%, 0.8%. And then let's put CNQ. Let's hopefully it does it a little faster.
We're back to
But
this
let's go
again.
ahead and set up our growth rates. So remember, it's averaging out at 23. Let's take a look visually at the growth rates here. So let's stay more or less in line with like inflation. So at the high end, I'll assume 10%.
Oh, wow.
And here it is, by the way.
Oh my goodness.
Again, it's showing how cheap they are, Austin. So
Yeah,
I think here we can assume some decay. Yeah, you see, we can assume some decay of -5%, and that's actually what the market's pricing it at. If you want average market rate of return, average market rate of return 10%, you can assume a -5% growth rate in cash flows, and you would achieve about that. But if you assume, as soon as you discount a little more, you can't assume that. So if you get a 50% additional discount right there, there you go. But analysts say it's a buy with a price target above 20.6% above that. So if you believe analysts, there you go. Let's start discounting a little bit less, 8%, 7, and then 5. Let's go lower 2. All right, so then let's start discounting it at 20%. Let's see what we get. All right, so now we see that at 20%, just to reiterate, Suncor is definitely cheaper than CNQ. And that might be because of the quality of their assets. Some probably a little bit of some details going on there. Dividend yield of 3.52% around there. And this one's got dividend yield 2.9%. All right. We're both doing buybacks. They're both in Canada, outside of the United States. So the benefit of buying these, if you're wondering, you're correct. You're actually free from the risks of the United States or domestic policy influencing your production. In fact, if you're the bigger oil players, you want to make the Canadian government make it really hard for new players to come in. That's what your goal is. So I'm not a Canadian citizen. I'm not actually really familiar at all with Canadian politics. However, you want to make sure that the politics are more or less in your favor. How do you measure that? If the political landscape is making it very difficult for new players to enter the market, then you're on solid footing, because essentially you have the right to win, because it's harder for people to just come in and start, drilling, right? So if that's the case for Suncor and Canadian Natural Resources, more power to you. Now, the next one is one that I already discussed, but it's a play with the thesis that these Western countries are going to make it very difficult for production to be done domestically on land. So if there's going to be the entrepreneurial mindset to like provide or that supply to meet that demand, then companies like Rig are going to be the ones that might be able to do it. Now, a key highlight of the ones that we've talked about, this is the riskiest. Okay, this is by far the riskiest. But however, if it plays out, this is the one that would generate the greatest returns.
Interesting.
Yeah, okay. By far, because this company basically focuses entirely on on offshore drilling. Okay. So if I show you, for example, the long-term price movement, it's terrible. It's absolutely abysmal. I think you're down since its existence by 62%. Absolutely terrible. And for the unfortunate souls who invested over here in 2008, poor you.
Ooh, yeah.
However, you want to not extrapolate from past results into the future, but it is a good way to check, like, okay, what's management been able to do thus far? And then it's like maybe a confidence test if you believe they're capable of changing things and performing differently going forward. I know that
So I
management,
actually have a question now. What
yeah,
is it about this specific entity itself that makes it different than the other ones that we're looking at right now, other than really
offshore
that
drilling.
focus? Yeah, but other than really that focus on offshore drilling, like, are there more implicit risks in offshore drilling? Is it more lucrative in some respects or others? Would you explain a little?
It's the size of the business. So scale really matters. So like as
Yeah,
I've been trying to discuss or convey, the benefit of what's going on is if the domestic policy changes to one that is more antagonistic towards domestic drilling, you want
yeah,
large players. If the sentiment or policy changes tomorrow to become more lenient, you actually don't want the large players. So big boys are great when you can use the power of the government to stop your competitors, basically. And that's basically at the end of the day what it is doing, because these countries will still require the supply. They're not going to completely shoot themselves in the foot. Maybe some of them
yeah.
will. But for the
Hopefully
most
not.
part,
Hopefully not.
no. I mean, no. For me, I hope so, because I'll benefit monetarily speaking. But I don't hope for, everyone's pocketbooks that happens. I mean, I'm shielded from it in a way again, but I'll change my mind if the facts change. So I'll be out of it if I start to see United States come back online, because that's the risk I'm looking at. I'm just looking at United States. If all of a sudden I hear the administration or Congress start to become more lenient towards it, I'm out. I'm completely out. I'll sell out. I'll take my profits. I already took some profits, but I'll take all the profits out. With Transocean, again, can you guess when they started to have a crazy outperformance?
After the 2020 election.
Yeah, and they've actually performed with Occidental, so about 300%. And then, I mean, I think at one point, they were close to 500%. So
Wow.
yeah, right there, 658%.
Oh my goodness.
If you
Wow.
had sold at the peak. But if you still held and you bought with the same thesis, you're up 323%. Still. Okay. Yeah. You're destroying the market. Goes to show you again, if you can leave your opinions or preconceived notions at the door and truly like analyze an industry and kind of draw honest, logical conclusions. And you just formulate a logic tree and then be honest with yourself. Like, I like to use a whiteboard when I do it. And then like, you make sure that you don't formulate a break. And I can do it in my head too, because I can just draw it out. And if you're breaking a bridge basically to come to the next conclusion, then you're breaking your logic tree. And then, for example, so, and then you got to make sure you understand where your gaps are in your logic tree. Like, oh, I don't know, for example, that level of microeconomics. So then go out in there and learn. You have YouTube. You can go out and like learn macro economics, all these different kinds of concepts. So you didn't really need to take the class in macro to come across the terms that, energy isn't an elastic product, et cetera. But I think I'm hammering that in too much. But with growth rates, I think, I think we're assuming it's a negative number. So we probably, let me see this. Okay, are we at negative cash flows? Oh, because I'm not even discounting it. That's why.
There you
Silly
go.
Fabio. Tricks are for
Yeah.
kids. All right, anyway. I already can tell you this is extremely cheap because I think I can discount it at 20%. This thing is priced for, I think, decay. I think I remember this from the last video. So yeah, it's priced for decay. So it's priced for a negative 5%. This is how cheap it is. This is what I'm saying. It is by far the riskiest. Okay. But if things work out, if things play out, and I'll tell you how they play out. So not only do you have to worry about execution, not only do you have to worry about that, okay, that's a separate thing. So the assumption is they execute. Okay, what you have to worry about is United States domestic policy alleviating itself. If that happens, right? If that happens, this will not be a good investment. Okay, this will probably not be a good investment. This and Rob actually kind of states that. So I'm not going to be attacking Rob at all, because he states that he believes going forward. So under his thesis, he believes going forward, the United States will continue to kind of cuck itself in terms of energy production, and this will allow companies like Transocean to really address the rising needs of energy. So all that demand it's not going to change. Basically, demand's not going to change. Demand is going to increase by 1% per year, about 1% per year in aggregation. If supply does not meet demand, prices will continue to rise. Sometimes the saying is the greatest cure for high prices is high prices. Because if I'm an entrepreneur and I see, oh, everyone's making hand over fist margins on this oil, right? I'm going to go out and try to find oil. So if you need to find oil, one of the places we can explore is offshore. Offshore will probably grow tremendously. And then so that oil that's not being produced in the United States will just be found, hopefully, for the sake of the middle class and the lower class, hopefully it will be found elsewhere. And in the meantime, while that's happening, that humanity is further figuring out how to, over time, find other energy sources. But the point is, in the current reality that we live in, that's not the case at the moment. But hopefully that will abide or bide our time, so that when we get there, we can no longer have that problem, which Elon Musk has kind of pointed out. And I don't like to quote him too much, but he said that the logical conclusion is, since we know it's finite, we should probably get off of it at one point. So we are working towards that, and there are a lot of companies doing that. But as Sven Carlin kind of said, it's the yields on that are really low, because everyone and their mother is trying to sell these assets and then buy those assets. So these are the unloved, hated assets, and as you can see how cheap they are. But they're also only cheap if you think the United States will not come back online. Does that make sense? So I don't think I should go any further than -5%, because I'm discounting this thing at 20%, -5%. So anything above -5%, this thing is a buy.
Yeah, basically, I mean, it's pretty self-explanatory.
Let's assume the crazy dilution that they're okay. So as soon as I plug this in, it's gonna destroy it, because I'm assuming tons of dilution. I'm assuming actually less dilution than they have been doing in the past.
Change it back to a 10% required rate of return, and then put in the 15% dilution. Wow.
Yeah.
No, it's cheap. I mean, this has been such an interesting lesson for me too, just seeing how actually cheap these companies are right now. This is kind of an interesting case study too, to just sort of get a glimpse into a potential set of companies that are just hated by the market right now.
Well, and it's also, hopefully I'm also doing a decent job of it, like helping people understand you have to dispel preconceived notions about how something will occur. And it's difficult. It's actually easier when you're an outward looker. So like, for example, if you're someone who's not American looking at the American political system, it's sometimes easier for you to make conclusions about that, just as is it for us to make those same conclusions maybe about Russian companies, right? And Russian policy, because we don't have skin in the game. So therefore we don't, tie our emotions to it. And then same thing with, perhaps if I dedicated my time to like study Canadian domestic policy, I can probably find ways that they're, just absolutely screwing up. And then if I really believe that, and again, you have to be honest with yourself, because if you're wrong, you're going to lose money. But but if you're making a good analysis of the situation and you think that they're doing something that's stupid, then you can probably take the other side of the bet and then profit from their stupidity. But it's often difficult for domestic players to play that game, because they often have an emotional tie to the very thing they're trying to analyze. And then emotions often, hurt
cloud
us.
pretty much anything. Yeah.
Cloud judgment.
Emotions cloud a lot of things. Yeah.
So, I'll talk about the last company, then we'll kind of finish off. But so far, you're drawing the same conclusion I would. They're very cheap. They're very cheap for a reason. The very big risk is the United States. The United States is the black swan event for this industry. If tomorrow, the administration came out and said, we're going to alleviate and allow domestic production to kind of flourish again. And then Congress said the same thing. We're not going to, put in more restrictions or anything like that. And then they can change sentiment going forward. Then we would see a tremendous amount of drawdown in these oil companies. You would see a big price drop in big oil companies. All right. So last one, EDP. So this is the one that's all the different. So one of these is not the same, and this is the one. So this is a pipeline company. And
interesting.
Yeah.
So what's a potential thing that makes this one really interesting, if it is interesting to you at all?
It's only interesting as an income play. Okay. So I would not, and I'd be actually very careful for people who are not consulting a licensed tax professional about it, with who that person may understand your situation, because this is an MLP. And when it's an MLP, it does make the tax situation a little more difficult. You get a K1 when you get the dividends, and a lot of the dividends won't be really taxable. Okay, so actually, this is not the ticker symbol. All right, small technical difficulty on my brain. I put in the wrong ticker.
Yes. It's all right. It happens.
Enterprise Products Partners LP. So as I was saying, the issue with this is the limited partnership, which does have different tax implications. You can see that analysts say it's a strong buy with a price target of $28, implying a 34% increase in the share price. Without putting in any growth rates at a 10% discount rate, it does imply that it's a buy. And I'll tell you one big reason as to why. Well, it's that nice old dividend yield of 8.47%. If you assume that it's safe and they'll continue to do so, you only need to make up for about 1.53% in terms of capital gains to get that return.
My question now, you mentioned that this company was an MLP. Could you go into what an MLP is, a brief overview of what it is, and then maybe why it may, some reasons why it's beneficial and other reasons why it could be some areas of concern that you like to keep an eye out on?
So reasons of why it's beneficial is tax reasons. The entity won't pay taxes. The entity is a pass-through entity and you pay the tax. So a lot of the problems with an MLP is the complications that they bring to your taxes, because some of the dividends that you receive will be capital returns. Some of them will be actual income. And as you get capital returns, it actually lowers your cost basis in the entity without you ever doing anything. So eventually, if you hold this thing long enough and you don't reinvest the dividends, let's say you just take the dividends and you go away, eventually you will have a cost basis of zero. And then all of the dividend will be now taxable income, which, something you'd have to keep track of. And then if you were to ever sell it, your cost basis would be zero. So whatever you sold it for would be profit, technically speaking, on a tax basis. So in fact, holding this thing in a tax advantage account is actually not, to my understanding, the best way to do it. Again, this is something you have to talk to your licensed tax professional that knows your situation. Yeah. If you have questions, specific questions, I cannot answer specific questions for you. And especially if you're foreign, I don't even understand if what the implications are if you're not an American citizen.
Yeah.
But you'd have to talk to, again, a professional who knows your situation. So not assuming any buybacks. You asked for the problems as well. So the additional problems is that oftentimes they have to increase their investments through share dilution. They've actually, the reason why I picked this one out of others is the share dilution is not that bad, but this is also like considered to be the best of the best within the pipeline. It's one of the best. And the average buybacks, it's been a dilution of 0.24% per year for the past 5 years. So that's actually really good for this kind of entity, because it's kind of like a REIT. In order to make more investments,
little nuance,
yes, because it's a pass-through entity, so it has to almost pay, I think it's 90% of its taxable income, or some great percentage of it in the form of dividends. It has to do it. And pipelines are actually one of the stipulations within the government that allows them to be MLPs. So MLPs have to fall under categories of business that allows them to become an MLP, and pipelines is one of them. So assuming the share dilution, Let's actually bring this down to size, but assuming share dilution of negative 0.24%, we can see that it's still actually buy, because again, look at that dividend. If you think that dividend is sustainable, the only capital appreciation you would need to achieve 10% per year is an additional 1.53, which is fairly easy. And then let's assume some decays, because that's actually what I think the market is kind of pricing in. And it's still a buy. So let's go a little more aggressive. Still a buy. Let's see a little more aggressive. Still a buy. See a little more aggressive.
It's like right there.
All right. So we can assume
like a 3% decay.
Yeah, between -3 and -4% decay at 10%, even assuming a negative 2.4% share dilution. It's the model's telling us to buy, and we can allocate. I didn't assume a last minute. Let's go -5%. All right, so -5% would be bad enough for it to say no. And then let's actually give everyone an equal weighting. All right, so it's saying I can put, with these assumptions, put 2.62% of my portfolio in there. So let's just count it at 20%. It's been growing at about 11.76%. And this is to show you just how cheap these are. And MLPs are fairly cheap when compared to stocks. But again, there's a couple theories as to why I keep doing that, and I don't know why. It's EPD.
It's all right.
But let's take a look at the max chart to show you. So they've actually had decent performance since IPO, and if you take dividends into account, your performance is actually fairly okay. It's pretty good, because the dividends, again, the purpose of this entity is to provide you income. But hey, take a look at when they started to suffer.
Yeah. Okay.
What do you think was happening in the United States under this context? And there's a reason why I brought this up. This is an American company. Guess what was starting to be built everywhere around this time?
Pipelines.
Yes, competition.
Yes.
Okay, so if you're this company, what do you want the government to do?
You want the government to stifle competition so you can be the only one around producing. Yeah.
So had to guess, when did they start moving up in 2020?
I don't know, Fabio. 2020 election.
Yep, around.
Oh, wow.
Right there. Yeah, this little dip. Who knows who wins? And then boom, about November 6th was the starting point. Got a nice little pop, and then it's kind of stayed there, because this one's not directly correlated with the price of oil. So their benefit would be actually not the same level as the other companies. Like Occidental Petroleum had the most to lose. Same with Transocean. They had the most to lose and the most to gain. Okay, so Enterprise Partners has agreements with companies to transport it through the pipelines. Okay, so they don't really care about the price of oil at the end of the day. And that's to the benefit and to the detriment. However, they do care how their prices are negotiated is if there's competition. If you have a greater sum of construction and development of pipeline infrastructure, wherever it is, and they're competing, it's like kind of like real estate. If I build a ton of homes and there's more homes than people, then the value of these homes is going to be less because there's more of it. So pipelines is kind of like real estate in that way. The more pipelines there are that go in, to a certain direction, the more I'm going to have to price compete in order to actually justify it, right? I'll come use my pipeline, use me, and I'll transport your oil properly, and I'll do it for this price. But if I'm the only one, and the government's not allowing new construction for whatever reason, could be justified, unjustified, doesn't matter. The point is, it does not matter. Then I can say, okay, well, you want the oil to go from here to here. I want a little bit more. I want a pretty penny. So it's good for them. So again, if you believe the United States will stifle its growth in infrastructure regarding energy and oil, regarding specifically oil, then this is actually some interesting exposure for you. And it actually would mean that going forward for a long time, that the income rate is pretty safe. And if you could have gotten it, I'll tell you, yeah, I'll tell everyone. We did add this to a family member's portfolio, and we got it actually around here, and they're holding and they're enjoying the income.
Nice.
But yeah, it's an income play. It's not really anything. All right. So I think with that, we covered enough stocks. This is a lot of stocks.
Yeah, I was about to ask you if you had any closing thoughts or any closing points of comment that you could give the audience before I wrap up the show here today.
Be careful with the United States.
Okay. So just be careful with the United States. All right. Well, with that being
Yeah,
said,
because who's the risk? What'd you
the
learn
United
today?
States
Who's
is,
the risk
yeah,
in this
the
regime?
basic. Okay. So what I
How will
learned,
how will Rob
yes,
lose his shirt in his investment in oil?
if the USA comes back online.
Yep, that's how you lose your
Yeah.
shirt. How
Yep.
do you win in this trade for oil?
The agents in power right now basically stifle the ability for domestic companies to
Plus
produce.
execution.
Yes.
Okay, I want to be
Mhm.
very clear. The companies have to execute well, and what will propel it further is if the powers that be continue what they're doing, which will be again great.
All right, cool. Well, with that being said, we are your hosts with the most, Austin and Fabio. This is the Capital Mindset Show. Please be sure to share the video. Really helps out the channel. Please be sure to like, comment, and subscribe, and visit our website at capitalmindset.org. We are your hosts. Take care.